Welcome to Talking Markets with Franklin Templeton. We're here today with ClearBridge Investments Head of Economic and Market Strategy, Jeff Schulze. ClearBridge is a specialist investment manager of Franklin Templeton, and Jeff is the architect of the Anatomy of a Recession program, a program designed to provide you with thoughtful perspective on the state of the U.S. economy. Jeff, thank you for joining us today in the studio.
Great to be here.
Jeff, you were just over in Europe talking with clients in the UK, Spain, and Switzerland last week. You mentioned that many of our clients were concerned about the health of the U.S. economy. Did the ClearBridge Recession Risk Dashboard for the month of February have any changes that have reflected recent weakness?
Well, that was a topic of conversation in almost every meeting, and really hasn't been a great start for a lot of the economic data that we've seen, a lot of the sentiment survey data as well. And some of this weakness has been picked up by the ClearBridge Recession Risk Dashboard. The month of February, we did have two indicator changes for the worse. So the yield curve went from yellow to red. And as a reminder, we're looking at the 10-year Treasury minus the 3-month T-bill as our proxy of the yield curve. It's the Fed's preferred proxy as well, and being able to identify a recession, but it inverted at the end of last month, and it is now a red color. And the other change was manufacturing PMI new orders went from green to yellow. That subcomponent, which is the most forward-looking aspect of that survey, went from 55 all the way down to 48.6. So we took a step backwards in some of these indicators that had seen improvements in recent months. And it's a good reminder that economic conditions don't move in a straight line. But importantly, if you look at the overall signal, it remains solidly in green territory. Out of those 12 indicators, 8 are green, 2 are yellow, and 2 are red. But overall, with the slowdown that we've seen and the U.S. economy, the weakness in the dashboard, we've modestly increased our odds of a recession from 15% over the next 12 months to 25%. But as a reminder to everybody, 25% is still extremely low odds of a recession in the coming year.
Okay, definitely some change there to keep our eyes on. Jeff, consumer confidence dropped fairly aggressively over the course of the last month. How much does that concern you?
Well, if we were talking prior to COVID, it would concern me quite a bit. Usually when you see a big drop of confidence, you get concerned. Are consumers going to stop buying cars? Are they going to stop going on vacation, stop going to restaurants? And then also, are companies going to stop hiring and stop doing CapEx, right? So obviously, this is something that bears monitoring historically speaking, but you've seen a change with consumer confidence after the pandemic. Consumer confidence has been low and has remained low over the last 4 to 5 years. And even though consumers haven't been optimistic, they've spent in a very robust manner, and the consumer really has been the workhorse of this economic expansion. So what I've been saying is watch what consumers do, not necessarily what they say. And even though confidence has dropped, that hasn't translated to weaker spending over the last 4 or 5 years. And really, the biggest driver of a change in consumption patterns has and continues to be whether or not people are losing their jobs. And with the jobs report that we recently got, with jobless claims kind of hanging in there and remaining strong, we think that the odds of higher unemployment and a potential recession are fairly low right now. And we think that the consumer backdrop is still very much robust with a solid labor market. And then also, household balance sheets are in fantastic shape, with household net worth up over $50 trillion over the last 5 years. So certainly bears monitoring, but it's not setting off the alarm bells for us on a change of the economy.
Okay, let me take a slightly different angle on this. It just wasn't consumer confidence. I think that retail sales also came in pretty weak for the same period. What does that mean for the health of that U.S. consumer?
Well, you always want to be wary of making too many excuses for some bad data points, but there's some very plausible explanations for the weak retail sales print that we got. First off, people forget this, but retail sales were unsustainably strong in December. You had a really strong holiday shopping season, and you got a little bit of a payback here in January. So this is just more of a normalized spending environment. Also, we think that there were some consumers that front-loaded spending because they were concerned about higher prices due to increased tariffs. So you got a little bit of a payback here in January, and you're probably going to get some more payback when you get the February number as well. And then the last one was really related to natural disasters and the weather. You had the Los Angeles wildfires that were prevalent in January, and then also January was the coldest January that we had here in the US since 1988. So that obviously disrupted retail spending overall. So when you think of all three of those factors, those are more idiosyncratic or temporary in our view, and it really doesn't change the trajectory of spending that we're expecting as we look to the second and third quarter of this year.
Okay, you've mentioned jobs a couple times in your comments already this afternoon. We recently got the February jobs report. What were your key takeaways there?
It was a pretty solid report, all things considered. That's why the markets were up on Friday when we got the payrolls report. Came in at 151,000, right around consensus expectations. Looking at it from a 3 or 6 month moving average basis, which kind of smooths out some jumpy prints that you can get from month to month. Still very healthy. 200,000 on a 3-month average basis, 191,000 on a 6-month average basis. More importantly, if you look at income growth, still well above inflation right now, which should continue to support consumption looking forward. But what I will note is that the government layoffs that have been talked about with DOGE, the reduction of the federal workforce, did not impact the report that we just got for February. That's going to start to show up in March and April. So the next couple of payroll reprints are going to be a little bit more bumpier than what we've been accustomed to over the last quarter or two. But overall, it was a pretty solid jobs report, and it's a key reason why the markets did rally on Friday.
You just mentioned DOGE, or the Department of Government Efficiency, and there clearly is concern in the marketplace around layoffs that have been announced that department has driven. How does this affect your view of the health of the expansionary environment?
We're going to hear about the DOGE quite a bit over the next couple of quarters, and it's really not going away. And there are downside risks to the economy. You have the actual impact of the layoffs from DOGE. You do have uncertainty that could weigh on maybe some CapEx spending decisions and hiring decisions for corporations. But it's important to look at the number of layoffs in context of the overall employment picture in the U.S. The U.S. employs about 160 million people. 7 million people are unemployed. 5 million people change jobs every single month. So these are pretty big numbers. The DOGE has announced around 100,000 job cuts, and that may get to about 200,000. And even if it does, 200,000 is less than the weekly initial jobless claims number that we get in the US, which is right around 225,000, 250,000. So yes, this is certainly going to cause some disruptions. It is going to create some bumpy payroll reports and some modest pullback of consumer spending as we look out on a 6 or 12-month basis. But the numbers that we're talking about just aren't big enough to really drive a change in our view of the trajectory of the U.S. economy. And I know that the federal workforce is big, but it makes up less than 2% of overall jobs here in the US. So again, this is something that we're going to hear about on the news flow pretty consistently over the next couple of months, but it doesn't really alter our view of how healthy the economy is and how healthy the labor market is in 2025.
The Atlanta Fed's GDP Now tool is currently flashing a negative 2.4% reading for quarter one. Two questions. First, what is that GDP Now tool? And then second, do you think a negative GDP print is coming for this quarter?
Well, the Atlanta Fed GDP Now tool is a nowcasting tool that looks at all of the data releases that you've had for a quarter, for example, Q1 that we're in, and it's their best guess of what GDP would be if it was released today. So it's a good way of kind of gauging how the quarter is going before we get the actual GDP release a month after the quarter's over. And GDP now went from positive 2.3% to negative 2.4% over the course of around a week and a half. So that's a pretty big swing. It's a 5% swing, all things considered. And the one thing I want to caution people on, and looking into this model too closely, is that when you're in the beginning of a quarter, and we've only gotten about a month's worth of Q1's data releases, GDP now can jump very aggressively. I mean, we obviously have seen that here, but when you look at why it's jumped, it becomes much less concerning. Yes, you had a slowdown in consumption, but as we talked about earlier, a lot of that was a pull forward and strong spending that we got from December, and you had some pretty cold weather in the US. But also part of it was higher imports in the US, which subtract from GDP. That's the front loading ahead of tariffs. You actually had a lot of gold imports, trying to avoid tariffs as well. And the one thing that I'd mention is, while I agree with the direction of travel of the revision, yes, GDP growth is going to be slower than what we've witnessed in Q4 and Q3 and Q2 of last year. The magnitude is very much overstated. So could we have a negative GDP print in the coming quarter? I'm never going to say no, because anything's a possibility, but I think it's a very, very small possibility. And my expectation for Q1's GDP is probably closer to 1 to 1.5%, which is obviously higher than where we currently sit right now. And the last thing I want to mention here, a lot of people don't know this, but Q1 traditionally is seasonally depressed. And even though the data is adjusted for different changes of weather and different patterns in economic activity, Q1 historically is much lower than Q2, Q3, and Q4. You saw it last year, you had a weak Q1. This year is probably not going to be any different. So there's a lot of reasons why, we're looking through some of the weaker data, and in particular, the readings that we're getting right now from the Atlanta Fed's GDP nowcasting tool.
Let's transition the conversation to the capital markets with a focus on equities. It wasn't just the consumer confidence that has recently dropped. I believe we saw some information recently that spoke to investor confidence also taking a dip down. Is this a negative or a positive for investors' perspective here?
It's a positive. Investor sentiment has dropped pretty dramatically. One of my favorite ways of gauging retail investor sentiment is the AAII bull-bear spread. So basically, this is a survey that looks at the number of bulls minus the number of bears. And just 2 weeks ago, we had one of the 10 worst readings in this survey's weekly history, going back almost 40 years. Top 10 worst. And usually when everybody's extremely bearish like we are today, it's actually led to really strong forward returns. So on a 3-month moving average, when the AAII bull-bear spread is in its bottom 10 percentile, so bottom decile, worst readings, the most bearish like we are today, your forward 1-year S&P 500 return has been 13.6% on average, which is the best reading out of all of the deciles that you have in this observation. So this usually signals a major market bottom, and it wouldn't be a surprise to me if you start to see the markets move higher near term because investor sentiment is washed out. So believe it or not, investor sentiment actually is a contra indicator, and when everybody's really bearish, that usually has some bullish forward-looking implications.
So Jeff, U.S. equity markets have been choppy or volatile over the course of the last month. What's driving this recent price action, and where do you see opportunities?
Well, coming into 2025, when we go back to the podcast a couple of months ago, we had always felt that the first half of this year was going to be choppy with some downward pressure on equities because of policy sequencing. This time around with the new administration, we're going to be dealing with some of the market unfriendly aspects of the new administration, like immigration, like DOGE, like tariffs. We're going to deal with those first before visibility starts to come from more of the market friendly aspects of the administration, like tax cuts and deregulation. So we've been anticipating this volatility, and obviously this is something that has created the market choppiness here over the last couple of months, which is not only just a growth scare, but it's also the uncertainty due to the tariff picture. There's also seasonality that's in play right now. Usually you see some market choppiness in the first few months following the inauguration of a new president. Also in year 3 of a bull market, tends to be a little bit more challenging on the front end than what you see in years 2 and 3. And we entered into year 3 of this new bull market in October of last year. And then from February to July, you usually see more defensive leadership in the market overall. So there's a couple of things that are weighing on the equity markets, but ultimately, where are the opportunities? As we just mentioned, with investor sentiment being washed out, for longer term investors, we're advocating to buy the dip. We think that there is a good long-term opportunity in U.S. equities, given the strength of the U.S. economic backdrop. We also are going to get the more positive aspects of the administration, like tax cuts and deregulation in the back half of the year. But we've been advocating that investors really want to look at active managers in the large cap space because of the market concentration that you have in the S&P 500. So right now, the top 10 stocks make up about 37% of the index. And when market concentration of those top 10 names has been above 24% of the index, so well below where we are right now, your forward returns of the equally weighted index, or the average stock, versus the cap weighted version, the equal stock is outperformed by close to 7% per year, each year over the next 5 years, with the hit rate of the average stock or the equally weighted index outperforming close to 92% of the time. So you saw the equally weighted version of the S&P 500 outperform in February. The Mag 7's total return last month was negative 8.8%. And we think that this rotation out of these large mega cap tech stocks and into the average stock is going to continue as we look forward in 2025, which is going to be a nice tailwind to active managers that can sidestep some of that concentration risk. So, we think it's going to be a fluid environment. We think it's going to be choppy, but ultimately, with the economy still intact, we think that there's more upside as we look forward on a 12 to 24-month basis.
So, Jeff, you did mention there the word tariffs as a potential or key driver of this uncertainty and volatility. Just wanted to give you an opportunity to provide maybe any additional perspective you have for us to think about on a go-forward basis.
This was probably the biggest topic of conversation in Europe last week. Obviously, tariff picture is a very fluid situation. In a lot of meetings, I was advocating that I would think that the tariffs on Mexico and Canada, that 25% across the board tariff, would be postponed to April. It was postponed to April. But once we get to April, you're going to have the reciprocal tariffs come into play. You're going to potentially have some European Union tariffs come into play. So there's going to be a lot of noise that's going to be coming out on the tariff front. And I think that's a key reason why the markets are going to be choppy over the next 3 months, give or take, until we can actually size up the scope and the depth of what tariffs are coming to fruition. But ultimately, I don't think large tariffs are going to go forward on Mexico and Canada. Both countries have made concessions and shored up the border to reduce immigration and fentanyl flows. Mexico has even extradited a number of drug cartel members to the U.S. as well. But I think because of tariffs, ultimately, this is going to create some choppiness in the markets over the next couple of months. And while I do believe it is a negotiation tactic by the administration to get better trade terms and concessions from our trading partner, and I don't think it's going to weigh on economic growth as much as people fear, it doesn't mean that there aren't going to be some pockets of volatility as we go through this period and we eventually get to the back half of the year where deregulation and tax cuts are going to come into focus.
Jeff, any closing thoughts or comments for our listeners today as we look to conclude this afternoon's conversation?
Yeah, the markets don't go up in a straight line. We had some really good returns in the S&P 500 in 2024 and 2023. And we are going to get some more positive elements from the administration in the back half of the year. And my expectation is for a tax package that's going to be more stimulative than what the street expects. And then obviously deregulation will be front and center. So even though we are going to have a digestion period here and we are going through that, this is very common for year 3 of a bull market. It's very common in the beginning portion of a new president's administration. But ultimately, given the strength of the U.S. economy, given the earnings delivery that you've seen from the U.S. equities, we think that this bull market has further to run. And we'd be advocating taking advantage of any weakness that you do have for your portfolio allocation decisions. And then lastly, the Magnificent Seven has been the only game in town over the last couple of years. We think there's a number of catalysts for rotation into small caps, into mid caps, the average stock in the S&P 500 into value. And we talked a little bit about one of those catalysts potentially being that the Magnificent Seven has more international revenue than small, mid, and the rest of the S&P 500. But in the back half of the year, there's going to be much better earnings delivery from these areas that have lagged, which should create much better relative performance. So while diversification has been subtractive when it's come to U.S. equities in 2023 and 2024, we think that this is the year where diversification is going to be additive to your portfolio returns.
Jeff, thank you for your time and your insight. To all of our listeners, thank you for spending your valuable time with us for today's update. And if you'd like to hear more Talking Markets with Franklin Templeton, please visit our archive of previous episodes and subscribe on Apple Podcasts, Google Podcasts, Spotify, or any other major podcast provider.
This material reflects the analysis and opinions of the speakers as of March 10, 2025, and may differ from the opinions of portfolio managers, investment teams, or platforms at Franklin Templeton. It is intended to be of general interest only and should not be construed as individual investment advice or a recommendation or solicitation to buy, sell, or hold any security or to adopt any investment strategy. It does not constitute legal or tax advice. The views expressed are those of the speakers, and the comments, opinions, and analyses are rendered as of the day of this podcast and may change without notice. The information provided in this material is not intended as a complete analysis of every material fact regarding any country, region, market, industry, security, or strategy. Statements of fact are from sources considered reliable, but no representation or warranty is made as to their completeness or accuracy. What are the risks? All investments involve risks, including possible loss of principal. The value of investments can go down as well as up, and investors may not get back the full amount invested. Equity securities are subject to price fluctuation and possible loss of principal. Small and mid-cap stocks involve greater risks and volatility than large-cap stocks. Fixed income securities involve interest rate, credit, inflation, and reinvestment risks, and possible loss of principal. As interest rates rise, the value of fixed income securities falls. International investments are subject to special risks, including currency fluctuations and social, economic, and political uncertainties, which could increase volatility. These risks are magnified in emerging markets. Treasuries, if held to maturity, offer a fixed rate of return and fixed principal value. Their interest payments and principal are guaranteed. Active management does not ensure gains or protect against market declines. There is no assurance that any estimate, forecast, or projection will be realized. Investors cannot invest directly in an index, and unmanaged index returns do not reflect any fees, expenses, or sales charges. Past performance does not guarantee future results. Any companies and/or case studies referenced herein are used solely for illustrative purposes. Any investment may or may not be currently held by any portfolio advised by Franklin Templeton. The information provided is not a recommendation or individual investment advice for any particular security, strategy, or investment product, and is not an indication of the trading intent of any Franklin Templeton managed portfolio. Data from third-party sources may have been used in the preparation of this material, and Franklin Templeton, FT, has not independently verified, validated, or audited such data. FT accepts no liability whatsoever for any loss arising from use of this information, and reliance upon the comments, opinions, and analyses in the material is at the sole discretion of the user. Products, services, and information may not be available in all jurisdictions and are offered outside the U.S. by other FT affiliates and/or their distributors as local laws and regulation permits. Please consult your own financial professional or Franklin Templeton institutional contact for further information on availability of products and services in your jurisdiction. Issued in the U.S. by Franklin Templeton, 1 Franklin Parkway, San Mateo, California, 94403-1906. 800 dial Ben 342-5236. FranklinTempleton.com. Investments are not FDIC insured, may lose value, and are not bank guaranteed. Issued by Franklin Templeton outside the U.S. Please visit www.franklinresources.com to be directed to your local Franklin Templeton website. Copyright 2025, Franklin Templeton. All rights reserved. Podcast theme music by Adam Vodofsky.